Hi and welcome to our discussion on this topic, first time adoption of IFRS. This is one accounting standard which is probably a summary of all other IFRSs in some manner, right? So something that we're going to focus upon today is to understand what exactly is the implication of this first time adoption of IFRS. Practically, I should be reading, reviewing, applying this standard after I have been through every other IAS or IFRS. Now this is a bold statement that we want to make, that if I say it's a summary of all the IFRSs, it does not mean that if I do IFRS 1 then I've done everything else, but it is rather a bigger side of it, that if I want to understand IFRS 1 well, then ideally I should be knowing each and every other accounting standard so that I can apply. So to be able to apply IFRS 1 to a particular company, right? A lot of things are involved in this particular accounting standard, but precisely what we want to do here is talk about it in terms of, if a company is moving towards application of IFRSs, then what are the things it must know upfront? So that is something which is going to be the focus area of our discussion today, and also looking at the very idea of this particular accounting standard come into the picture. That if a company is adopting IFRSs, so I would say adopting IFRSs for the first time, right? Now this also brings in a lot of questions. Can there be a second time for adoption of IFRS or something like that? Although our discussion today would not want to focus upon this, what is the second time, or maybe looking at third time, or so on and so forth. But precisely we're talking about if an entity is applying IFRSs for the first time, then all the things it should be doing so that it is able to prepare its financial statements as per the IFRSs, right? It might sound a bit technical if we just discuss the language of the standard, so it is wiser if we use some numbers, some examples to understand this accounting standard better. Let us say that there is a US company let's say having an accounting year end December 31st every year, right? It's a US based company, so primarily it uses the US GAAP or the GAAP as we normally say, right? So let us say that it wishes to converge to IFRSs for the year ended 31st of December 2017, right? The US based company presently using the US GAAP, accounting year is 31st of December each year. It wants to move to IFRSs for the year ended 31st of December 2017. Now, why would it do so? First of all, right? Let us say that the SEC, Securities Exchange Commission, the FASB, in the US, they decide that companies in the US have a liberty now to switch over to IFRS. So they may have a choice to either use IFRSs or US GAAP as per their wish, and the FASB doesn't have a problem with that, the SEC doesn't have a problem with that. So, and of course we understand that any non-US and even a listed company in the US, they have this flexibility, they have an option to use IFRSs rather than using the US GAAP necessarily. So when I say that, it wants to do, it's prepare its numbers as per IFRSs for this date. So we just refer this to as a reporting date for us, right? So we are saying that this company wants to report its financial statements for the year end 31st of December 17, which is my balance sheet, income statement, statement of cash flows, statement of changes in equity, and we even talk about disclosures, right? So it wishes to prepare these financial statements or set of these numbers for the period ended 31st of December 17 as per IFRSs. What my standard says, the IFRS 1, the first time adoption of IFRS, is that okay, so you want to prepare these numbers as per IFRSs, please do so. There's no problem with that. But if you look at the comparable position for the period ending 31st of December 16, can you prepare one set of financial statements as per IFRSs and make a comparative balance sheet, P&L, statement of cash flows, statement of changes in equity, and disclosures or notes as per US GAAP? Are these numbers 1 year's financial statement as per IFRSs and the comparative years, previous year's financial statements as per US GAAP? Are these comparable? The answer is no, which means that even the last year's numbers are required to be prepared under IFRSs, and that is the only way you can facilitate comparison. An investor or a user of financial statements would only be able to compare apples with apples or oranges with oranges, and not IFRSs versus US GAAP or vice versa. And that is where we say that if you are thinking of adopting IFRSs for the year ended 31st of December 17, ideally you should be preparing the financial statements even for the year ended 31st of December 2016 to make a comparative view of things, right? And that is where we start looking at the origination of IFRSs. That while my reporting date could be later, 31st of December 17, I might have to start a little early, right? And that makes us wonder, what all efforts are we required to do when we want to adopt IFRSs for the first time? So we are simply saying that if there is a reporting date of 31st of December 17, you are required to prepare a balance sheet as on this date, income statement for the period ended this year, a statement of cash flows for the year ended 31st of December 17, a statement of changes in equity for the same period for the same year ended 31st of December 17, and relevant disclosures with respect to the accounting policies that you have adopted. Vis-a-vis, you would also need to give comparatives for the year ended 31st of December 16 for the balance sheet, income statement, statement of cash flows, statement of changes in equity and disclosures, right? That's the first point. More importantly, why I know that this is a statement for a particular period, statement of cash flows for a particular period, statement of changes in equity for a particular period, balance sheet as on this date, 31st of December 2016, and I start wondering if I have to prepare an income statement or statement of cash flows or statement of changes in equity starting year or starting period 1st of January 2016 until 31st of December 2016, ideally I should have also a starting point where I'm able to prepare a balance sheet as per IFRS, and that is where it becomes another point to consider, that if I'm looking at a report as on 31st of December 2017 or my reporting date as 31st of December 2017, where I prepare all my set of financial statements, I firstly need to have comparatives for the previous year and also my opening balance sheet as at 1st of January 2016 as per IFRS. Now this is one key consideration that I need to make, that practically speaking, this is my date of transition. This is the date when I have actually moved on to IFRSs, rather than talking about this date, which is 31st of December 2017. And henceforth, we are saying that if I'm looking at moving on to IFRSs on a particular day or a period, my date of transition could be well before the reporting date, right? So what we need to consider here is, look at the transition date, and the standard has defined this date very clearly. It says that, let me just put it across here. The date of transition is the starting date of the earliest comparative period for which the financial statements are prepared under IFRS. We are saying that the date of transition is the starting date of the earliest comparative period. I'm preparing my reporting date, or my considering my reporting date as for the year ended 31st of December 17. The comparative financials that I give are for 2016. So the starting date would be my date of transition, which is 1st of January 2016, and on this date I will change my balance sheet as per IFRS. So this is the third relevant point that comes to us now that we want to discuss. The first point that we discussed was, we looked at the comparatives to be made for the IFRSs. We looked at the date of transition as the starting date, and now we are looking at when I have come to my date of transition as the starting date, what all I'm supposed to do. One practical thing that I'm saying is, my opening balance sheet has to be as per IFRSs, right? So let's try to spend some more time understanding this statement well. The opening balance sheet date as per IFRS. What does it mean? What all am I supposed to do on this particular date? We are saying that on the date of transition, the entity must recognize all assets or liabilities whose recognition is required under IFRS. Now discuss that in detail. De-recognize all assets or liabilities whose recognition is not allowed under IFRS. Reclassify all assets, liabilities, equity as required under IFRS, and measure, most important amongst all assets, liabilities, equity as required under IFRS. 4 statements. When do we do that? On the date of transition. What is the date of transition? The starting date of the earliest comparable or comparative period, right? We are saying recognize all assets or liabilities whose recognition is required under IFRS. Typical example, derivatives. Lot of economies in the world do not recognize derivatives as financial assets or liabilities, as the case may be. IFRS say, first time adoption of IFRS says that on the date of transition you need to recognize all such derivatives, most likely at their fair value. I've just taken this fair value word here, which is more of a measurement thing, but the first point is recognition. I need to show in my balance sheet all the assets or liabilities which arise as per IFRS. Financial instruments are always the best example to talk about, right? De-recognize all assets or liabilities whose recognition is not permitted under IFRS. Many companies might recognize some preliminary expenses. In some cases we also call it miscellaneous expenditure not written off, or a deferred revenue expenditure, or preliminary expenses. Such kind of expenditure is shown in the balance sheet as an expenditure which would be written off over a period of time, so it lies in the asset side. It is shown as an asset, but IFRS simply say, no, we do not recognize such kind of assets. We do not expect any future benefits arising out of these expenses, so we do not want to recognize, which means that if I have any such kind of assets or liabilities in the books, they need to be cleared off. They need to be removed from the balance sheet when? On the date of transition. Right? Third one, reclassify all assets, liabilities, equities as required under IFRS. One clear example again is convertible debentures. If I have some convertible debentures, normally companies show them under liabilities. But what IFRS say? IFRS simply say that split them between the liability component and the equity component. Right? So that is something that you need to take care of. You would want to reclassify or present your existing assets or liabilities or equity as required under IFRS. And finally, you're saying the most important amongst all is measure these assets, liabilities or equities as per the IFRS, which probably means if I have any, let's say, investments in shares of other companies which probably I was showing at cost earlier, these needs to be shown at now fair value, because this is the only option available to me under IFRS if I have such kind of investments in some other company's shares. So what we are saying here is we would want to recognize all assets and liabilities which were not earlier shown in the books, but they are required to be shown under IFRS. Derivatives is one example that we're talking about. De-recognize all assets and liabilities which are not permitted. So we might be showing some assets or liabilities, but IFRS simply say no, we don't permit it, which means we have to take them off the balance sheet. Reclassify or represent assets, liabilities, equity as per the IFRS. We talked about an example like convertible debentures, and measure assets, liabilities, equities as per IFRS. We talked about this derivatives also, that derivatives are normally required to be shown at their fair value. So we do show them at their fair value. Right? When do we do that? On the date of transition. Right? So one part that comes in here is what all we do on the date of transition. Right? Now, the final thing that I want to talk about here at this point in time is basically looking at moving to IFRS. Certainly invites some costs, right? You need to obviously change your accounting systems. You need to really kind of train your people. You need to obviously change your, let's say, I would say policies. You need to obviously review those with respect to how to account for several things. But what you need to remember here is once you have moved to IFRS, you would be required to adopt and apply IFRSs on a retrospective basis. What does it mean? Let's try to understand that. We are saying your reporting date is 31st of December 17, right? Your comparables are 31st of December 16, and your starting date, the date of transition, is 1st of January 16. When I say I'm looking at a retrospective basis, all I mean to say is whatever IFRSs exist on this date need to be applied on a retrospective basis for the comparative as well as the starting date. We will be doing more discussions around this aspect of why do we do this. One basic aspect we look at is it is nothing else but a change in accounting policies, as you probably are moving to a new accounting standard or the new accounting policies, and that is why a retrospective application is required. But more so, what you also need to remember here is that the cumulative changes, that take place on the date of transition are recorded through retained earnings, right? This is one very important, very relevant impact that you would see when you move on to IFRSs. Let me try to explain that. What does it mean? Let us say that there is an investment in shares, let's say on the date of transition. We are saying on the date of transition, we are saying before the IFRSs were used or applied, the value, the carrying value of such investment was, let's say, $10 million, right, in your books. But as you applied IFRSs, as per IFRSs, let's say this change comes at 12 million. So what you're seeing is basically the change in the value of the asset has increased by $2 million. Good so far, right? Let us say likewise you have a forward contract that you need to recognize now. So probably you had no value of this forward contract in your books, but now this forward contract has become a kind of a liability because you moved into IFRS on rate of transition, and this comes to, let's say, $3 million, which means that my liabilities increased by 3 million. Net, we are saying the net impact from my balance sheet is coming at -1, right? So what we need to remember here is the cumulative change, the total change is coming at -1. That takes place, or that take place here, we're saying the plural here, on the date of transition are recorded through the retained earnings. So what I'm doing here is, in a very basic accounting manner, I'm saying that my assets increased by 2, so I may simply say debit assets, that is investment in shares, that is 2 million, right? My liability, which was 0, now has gone to 3, so I'm increasing my liability as well. My liability is credit forward contract, which is 3 million, and the difference between the two, the net change, the cumulative change is coming at a loss of 1 million. So I have to recognize this loss through retained earnings, and this is the entry that I'm doing on the date of transition. Are you good so far? So this is one entry that any entity is required to make for all the changes that it brings as far as the value of the assets or liabilities are concerned on the date of transition, right? So this is something that is one or the first step under the adoption of IFRS. What else happens in this accounting standard? I'm going to discuss that as well in the next lectures, right? Thank you very much.